CMQ investors, welcome to the show. I was just asked a question about, have I ever lost money investing? And if I did, what were the lessons I learned? So definitely when I was younger, when I was just getting into investing for myself, I definitely lost money. I didn't, I generally speaking, I'm good about not overdoing stuff. So I didn't put myself in a really bad spot or anything like that. And I made my money back. But the lessons that I learned from losing that money were actually some of the lessons that have allowed me to really gravitate towards, what Charlie Munger and Warren Buffett and others talk about. Because I realized, not just from reading what they have to say or reading academic studies, but I have my own personal experience that validates what they've already concluded. And so then that's allowed me to be a lot more receptive to their other recommendations, because I say, hey, I don't want to make these mistakes also. I can learn vicariously instead. So off the top of my head, what are some of the mistakes that I made early on? For starters, let's start with what I didn't do wrong. I didn't get into doing like options trading or shorting stocks or anything that was just wildly risky. What I did make mistakes doing, I'd say, are buying individual stocks and things that I thought I knew a lot about, but I really didn't know a lot about. I remember I was giving a talk at a college in Connecticut, and something came up about the brand American Eagle. And I did what I thought was a lot of research, because I thought, okay, I've got like an insight here. The new generation, they love American Eagle. I did what I thought was a lot of research. I wrote down all my reasons. And let me just say that too. I recommend writing down your reasons for buying a stock or selling a stock, because it's really fun to go back and look at it. And you can appreciate just either how much you're evolving, or in my case, I just go, God, I was so stupid. God, what an idiot. Who wrote this? But yeah, I thought American Eagle was this great opportunity. And some of the things I did wrong in my assessment is I was taking like metrics like PE ratios, or I'm trying to think what else, like the PEG ratio, or, go down the list of just whatever metrics that people say you should care about, and not really thinking I understood that, but not appreciating that they're just indicators of things. It doesn't tell me what's going to happen in the future. Right. And also just, I think I didn't have some certain psychological models down pat at that point. So, that example where I thought I got an insight at this university, that was availability bias, because I just had a very vivid example of people talking and telling me something. And I was like, oh, that must be everybody who goes to college. And then I found data that supported that, and I bought, a good amount of it. And the company was going through some tough times. And the way I remember assessing it based on like, I knew enough to look at how it was doing relative to other companies that were in its space, which, that's not always the case. So I looked at it in context of Urban Outfitters and Abercrombie and Fitch and all these different things. And I remember being like, oh, look how many stores they're opening versus how many this company's closing, and just things that in hindsight told me nothing about the true quality of the business. The other lesson I learned, and I've stuck with this, is I don't invest in retail fashion companies. I've worked with a lot of companies like that for my business, so I know those businesses well, and that was part of the false confidence or false sense of confidence I had investing in American Eagle. I'm like, well, I understand this. I know the retail space, I know the online retail space, etc. But it's a very difficult business because you have to stay abreast, or ahead rather, of what the trends are. You have to order inventory without being sure that everyone's going to love what you're putting on sale. The reason you see companies have sales, like actual sales, is because they have to get rid of the inventory because they already bought and paid for it. And if it flopped, they have to get rid of it, or else it's just total money down the drain. So I find that's a business where I do not want to invest in publicly traded companies that are in that space, because I just know that unpredictability, and there's just some companies can do it, but it's very difficult. And it's like what Charlie would say. It's like, I want to find easy things I'm like absolutely sure of. And I can't be sure about the future of a business in that space. And you could just look at all the different companies that were hot, retail companies that were hot at one point that, now it's like a joke, or they have to like come back into style. Like look at Gap. That's one example that comes to mind. But let's think, what other mistakes I made? Panic selling for sure. Buying something thinking I really understood it, but undervaluing or underappreciating the role of psychology plays. Right? Like feeling, oh, I got this. Yeah, this is what you load up. And then the company gets hit with some bad news. The market overreacts, and I'm thinking to myself, oh, where's my money? And, I sell. And in some of those instances, it would have been better just to hold for the reasons we've talked about before. But, if you have something that can keep being good for a long time, you interrupt the compounding process when you panic sell. So that I did that early on in, I'm trying to think what company it was. I think it might have been Facebook. I had Facebook was one of the first stocks I ever owned. I think it might have been the first. I was working for a corporation, and I joined a startup, and I had to go and get my, I had to buy a laptop for myself. The company wasn't providing it. So I took what was in my 401k at this corporation, at this corporate job. It was like 4K or something. And I took 2 G's and I bought a laptop, and I took the other 2 and I put it in Facebook. I've never touched that money, by the way, and that's done great. It's fun to look at it and think of it's a small scale example of what, we're talking about. You let something just keep on rolling. But, then I added more over the years. And I remember I thought I understood the Buffett Munger, load up kind of approach. Loaded up on Facebook, and then they got hit. It might have been the Cambridge Analytica scandal. I don't know what scandal it was, but it was one where Zuckerberg had to go to Congress. And, the news is $10 billion of value deleted from Facebook today as Mark Zuckerberg testifies in front of Congress. Is he a robot? We don't know. We'll be back 6 o'clock. Mark Zuckerberg's like, I don't know, Senator. We make ads or whatever. And that was just, I freaked out, admittedly. And so I have that written down on a little tracker I have for myself. It's like I remind myself of those mistakes, and I'm not repeating them, right? So Alibaba, someone asked me what's my average cost. I think I'm at 120 now, maybe 122. I bought a little more yesterday. But anyway, it's just funny because that's not funny, but what's not funny, that is funny. What's not funny is what's good is I've hung with it with Alibaba because I know, even though my gut was like, dude, you might need to reconsider this. I've made this mistake before. I recognize the feeling, and I know what the feeling is. I know I went through a period where I got really into behavioral finance. And, so I know the biases. I understand what it is I'm feeling. And even though it's still hard to act rationally all the time, that's helped me a lot. I'd say third mistake here would be, I think just speculating during COVID. I did well with my little COVID stocks. I did a good job, but there were instances where I just clearly shouldn't have done it. Give you an example. I think I thought Delta Airlines would pop, and so I bought some Delta. And I knew this was kind of speculative money. I wasn't investing the way that this is before the podcast and everything else. But everyone was making money during COVID on stocks. I was in CrowdStrike. I was in Match.com. I mean, I crushed it with those but I knew they were short term, and I had the wherewithal to know that okay, get out now, because it was a totally different sort of approach, and one that I don't recommend, by the way. But I had you have a bunch of wins, and then you start thinking everything's going to be a win, right? And it starts to turn into a casino where the more you play, the more likely it is that you're going to lose. So Delta was one where it wasn't I got crushed, but I lost some money. I sold out of it. I had the wherewithal to sell out of it. But had I kept going down that path, I probably would have been even on the pandemic. But I was up a lot of my little individual plays, just because partly some luck, partly I had some experience at that point. I got really obsessed with reading 10Ks and things like that. But then a couple of examples where I did something that was dumb, but then it's smart, I knew I should liquidate, was CrowdStrike, Peloton, and I want to say Match.com, but I did great with those. But I realized I don't really know these businesses. I think I do, but I don't. And so there's at no point am I going to be, if let's say the company has a turn, I don't know enough to override my fear in my stomach. So I knew that. So I'm all right, let's just take these off the table. And that was the smart thing to do. Now, in the case of Alibaba or any company I hold now, it's I really know the business. I take that part really seriously. I think of that little pandemic window. The first 6 to 8 months of the pandemic is kind of there was a unique time. And I don't recommend that approach. Certainly don't want to use that approach ever again, but look, it was crazy. It was crazy times. I'm trying to think what else, guys. Those are some mistakes. I think a lot of it comes down to just making sure you're not overconfident. making sure you have your temperament down, your psychology down, and then and trying to do less. I do not hold Tencent. I'm going to share my portfolio. I was going to do it last night. I've been so busy. I'm going to do it tonight, probably on my newsletter. No, I don't own Tencent. I think Tencent's very risky, more so than Alibaba personally. I might make a video about that. Alibaba is like, I think 12% of my portfolio. Like 51% of my portfolio is low cost index funds, like the VU and VTI. So that to me is intelligent. That's like me being smart, is by doing that. That's a very smart approach. I'm trying to keep my individual holdings to like 5 and then have them be at least 5%. So I have Apple, Alibaba, and Berkshire are like the 3 biggest. I think that's right. I bought some more Berkshire yesterday, actually. I bought some more Berkshire, I bought some more Costco. Not because I thought like, oh, it's a great time. I had cash and it was just like, okay, this is getting eroded by inflation. I should do something halfway intelligent. And I bought a little more VU as well, because I try to, I want to stay at least 50% in low cost index funds. But again, not investment advice, guys. Don't do what I do. But I'll stand by the results. Like I'm not one of these people that I'm not trying to sell a course. I'm going to teach you how to invest. It's like I want to be the best investor I can be. And that takes a lot of time. I think Costco, I don't know if it's a good buy. You've got to make that call. Costco is an awesome company though. I also think I don't buy things because it's, good for a recession, but I'll just say this anyway. I think it's safe in a recessionary time. It's Costco's, and if you really read into Costco, like you nerd out on it, you'll see why Charlie Munger loves it. It's an awesome company. On so many levels, like the business model, the culture, even just what they do, what they offer consumers. Like it's an awesome company. The cheapest gas in the country right now is on Costco. They're also doing really well in China, but they're smart. They're not like trying to roll out 100 stores in China, but their first store there, it's like people are lined up outside, like there's lines around the building. So it's amazing they can take, that recipe can be put elsewhere and it does well. And I say sometimes I like reading about these companies, not because I plan to buy them, because it's just, I learn stuff. It expands my mind. I love reading 10Ks. I'm going to do an episode or do a video where I do a 10K reading, like kind of live, where I'll have my screen going. And not that I'm going to be like, here's how to do it perfectly, but just I'm very kind of see how I read them. And I think I know a way to make them more interesting and fun. It's like I learn a lot about the world just by reading the 10K. And I also want to encourage that and make that more normalized, because I think that's something that it's really important people know to do that. If you're buying a stock without reading the 10K and the 10Qs and reading like the competitors' 10Ks, you shouldn't buy the stock. Thank you for listening to the CMQ Investing Podcast. And if you haven't already, make sure you subscribe on Apple Podcasts or Spotify. It's totally free, and that way you'll receive every new episode as soon as it's released. Thanks again, everyone. We'll talk soon.